continuing with the costs we include in inventory, we have to talk about special sales agreements because these are situations where the inventory there's no real sale, and so the inventory stays on the company's books. And what I illustrate here is what happens. These journal entries here, notice that these are not okay. This is what should not happen. What happens is you've got company A who pretends they have a sales transaction and they go accounts receivable, sales revenue. They sell stuff to company B. So what company B does with that is they have bought the inventory and they have an account payable to company A. They use this inventory as collateral to get a loan, a note payable. So now company B has the cash and they owe a note payable. So then they give company A that cash, okay? They're giving company A the cash and reducing their account payable to company A. And this is not okay because what this is what's called a parking transaction. Company A is parking their inventory on company B's books, and they have a side agreement that they will repurchase this inventory at a later date at a higher price, which means it's really a financing arrangement. So if you see something like this, these are not what's supposed to happen. What is supposed to happen is, what should happen is that company A just has cash and a note payable, okay? That's it. They do not, the inventory stays on company A's books, and it's really a financing agreement. Okay, so that's a special sales agreement. Not a sale, inventory stays on the books. The other thing we have to deal with are sales with high rates of return. And this is normal in a lot of industries, like textbooks, where, say, 30% normally get returned. So the goal of recording the accounts receivable is to have that on the books at what the company expects to collect, or the consideration they expect to receive. And so this is a situation of variable consideration, since some of the accounts, some of the sales items will be returned. And so what the company has to do in this situation is, if they can estimate the amount of returns, then they can book the revenue, but along with it, they have to account for the potential returns. So what do? They do accounts receivable, sales revenue for the entire amount sold, but then they have to use this allowance for sales returns and allowances account and reduce that accounts receivable. This is a contra account to your accounts receivable, so that the accounts receivable are stated at their what they really expect to collect. In addition, on the inventory part of it, you have to set up an account inventory of estimated returns based on their estimated returns, and you reduce the cost of goods sold for those estimated returns. Okay, so those are special sales agreements, sales with high rates of return. Then this will be just probably a quick review of other things related to inventory. The general rule is we include the product costs in inventory. Those are directly related to the inventory. These would be all of these things: the freight in, insurance in transit, anything involved in the manufacturer or of those inventory items. Okay. Usually your interest is not capitalized on any of these unless it's a large discrete project, say like a boat or a subdivision. Okay, so product costs are inventory costs. Period costs, these are your officers' salaries and all of these administrative costs, financing costs. Those do not attach to the inventory, and FASB specifically says you can't capitalize interest costs on inventory except for the large projects. So on recurring routine inventories, no interest can be capitalized. Okay, the other thing we get to are purchase discounts, and we have to be able to do the gross method and the net method for these. And I'll take just a minute to work through one of those. Let's see. Great, you don't have that. In a minute, I'll do that in another video. I will work through one of the ones with the gross and the net method. Okay.